So yeah. So for IDBI Federal, which is a life insurance company, you can see the website here. Okay. So it's a life insurance company. They've also tied up with this other company. So it's federal, the federal bank, IDBI. I would assume this is federal bank. Okay. And
Yes,
this
sir.
is a foreign insurance company. Okay. So get to know a little bit about the foreign insurance company, because these are, so this is basically understand what is happening in terms of the business here. Okay. This is basically IDBI Federal, or let's first talk about the business side of it. So this AGS, I haven't heard too much about these guys, but you can look them up. Okay.
Yes,
AGS
sir.
Insurance, this must be an MNC insurance company. Look them up and see what kind of stuff they're doing. Okay. Have a look at their website as well, because that basically defines your product mix mainly. Okay. So the business is basically, your AGS is whatever, I'm not spelling it correctly. Okay, these guys will give you the product expertise. Okay, and your this is the first part of it, and the ID, and basically IDBI and Federal Bank. Okay. This Federal is Federal Bank, right?
Yes, sir.
Yeah.
Federal Bank.
Yeah, IDBI, these guys, what are they doing? Try to understand it from a business point of view. They are providing the distribution channel actually. All right. There with their staff, with people like you, also chipping in, you will be basically involved. And so these guys are basically going to define the product largely. Okay. They'll try to bring in some of the international product expertise. The spelling is also not correct. But anyway, so that's the basic idea. But anyway, in Indian, life insurance products are quite well defined. Okay, so this is the basic business model. These guys bring in the MNC brand name and the product expertise in life insurance products, and then you have these guys providing the distribution channel through their branch network and their other sales people that they can line up, telesales and all that stuff. And so, what are you selling? Mainly investment products. One is basically your ULIPs, okay, unit linked in the investment products. Okay, quite heavily regulated, but very still quite high margins. Okay, so you have to understand the history of this. There is a history of mis-selling with investment products. You understand what mis-selling is?
No, sir.
Okay, so mis-selling is basically where you sell inappropriate investment products.
Okay.
So you basically take an old person who's quite old, retiree or somebody, and you put like 95% of his savings. If you're a financial advisor, you're putting 95% of his savings into growth stocks, which are generally quite high risk. Okay, so basically this means selling inappropriately selling investment products would be the right way to put it. So this is a big issue actually from a regulatory point of view. So again, inappropriate spelling may not be right. Inappropriate spelling itself is inappropriate. Okay, inappropriately selling investment products. What that means essentially is that you're selling, like an example is an old retiree who really needs to be mostly in fixed income. They need to be in mostly very safe fixed income products so that they can get regular income. They're not in a position to take risk because they don't have much of their life left. But you sell this guy a high risk investment product like a growth stock portfolio or something. Growth stocks are generally quite high risk, and so that's and then the guy ends up losing money. Okay, so that's basically what you call mis-selling. A very big problem in the financial services industry because all these firms have big. So just ignore the background noise. All these firms have big targets, and pretty much I wouldn't say the only way they can fulfill the targets is by, but the targets are very ambitious actually in the short run. So eventually you always have this problem of mis-selling. This is very rampant in the financial services industry, no matter how much you regulate, because these guys need to, you just remember that this is a good thing to be aware of. There's a recent case, I'm drifting a little bit from here, okay, but you should be aware of this, read up this case, okay, recent case of, I think it's Yes Bank. Yes Bank 81 bonds, okay, 81 bonds
81
are,
bonds.
yeah, read up on this, Google this and read up. SEBI has levied heavy fines, okay, but you should understand this problem because many of you are going to go into this kind of a role, selling investment products, whether it's for a bank or insurance company, okay, or asset manager. So there's always a risk here because the main problem is that short-term targets of these financial services companies are very, very aggressive, and it becomes very difficult for salesmen to fulfill them without engaging in mis-selling. Okay? So SEBI has fined even employees of Yes Bank I saw one guy with 1 crore, some another guy with a few lakhs. Okay, individuals have been like, they've caught individual salesmen and fined them. This guy was the head of the unit, sales unit. So they sold these 81 bonds. 81 bonds are actually related to the BIS capital standards, okay, capital adequacy standards for bonds. So these are basically equity like. These are very high risk actually. 81 means additional tier 1. Tier 1 is a capital ratio standard for, according to the Basel framework. So tier 1 means it's basically like equity. So basically high risk capital, which can evaporate at any point of time. So main first line of loss absorption. Okay, and 81 is additional tier 1, but it is additional, but it is still tier 1. So it is very equity like. Okay, in the sense these are high risk bonds. Okay, these can disappear any moment. You remember when I discussed the Solomon case with you, I discussed COCO bonds. Remember that? Contingent convertible bonds.
Yes, sir. Yes. Solomon versus Solomon.
You remember that when I discussed that, when I was discussing the capital structure, I was discussing these new bonds which have come up in Europe, contingent convertible
Yes,
bonds. Okay. So those are also very similar to this because those bonds can vaporize if the bank suffers big losses, even though they're actually debt securities. Those the principal can be wiped out. Okay. So these are the nature of these kind of bonds. Okay. Now, what happened with Yes Bank is that they sold them as super FDs. Okay. Now, as you know, in India, the culture is that we have a great deal of faith in bank FDs as a very safe products. So these guys went and sold these high risk bonds, equity like high risk bonds of Yes Bank, 81 bonds. It may have been not even the Yes Bank's own bond, but the salesmen were from Yes Bank. But they basically sold 81 bonds, which are very high risk products, and sold them as super FDs, which you know from the Indian investment culture. So bank FDs are considered very safe. So you basically misled the investor. Okay. So either you misled the investor. The investor doesn't even know what it means to be led. He's just blindly trusting you, and you're selling him inappropriate products. So this is a very big problem in the financial services industry. It's been going on for ages. Okay. So they've never been able to fix this, and probably never will. So very important to be aware of this because you are going to be under this kind of pressure when you're a salesman in a financial services setting. So you got to watch out for this stuff because this stuff can come and hit you even as an individual. So be very, very careful. Compliance with regulatory norms. So therefore, you have to look out for regulatory norms. Okay. So since they're talking to you about, I'll stick with caps. So basically, watch out for this. You have to look at IRDAI. Okay, you know who these guys are?
Yes, sir. Insurance Regulatory Authority of India.
Yeah. Okay. So these guys. So just check them. We have an act also, right? So now you've done a law course, so you're comfortable going through the legislation. Go just like we went through the Contract Act, we went through Companies Act. You go through. Just don't be afraid of it. Go through the insurance legislation. Go to the IRDAI website. Check their legislation on insurance. Go to this. So be aware of the. This is a very heavily regulated industry, insurance. So be aware of the regulatory framework, be aware of the problem of mis-selling, what has been happening recently. Go and research this incident. Yes Bank finds. You may find something on the SEBI website also. Okay, now coming to ULIPs, basically what are these? These are actually, one of the mainstays of the life insurance industry is basically because people don't want to buy life insurance, okay? So what you do is you mix investment with life insurance, okay? So this is basically the kind of product, okay? So mixing investment and life insurance, and generally still very high commissions, okay? These are very, and that's why you have mis-selling, okay? Because the commissions I think they've been brought down now, but still quite high, okay? And used to be very high for a long time. It would be 6% commissions. So if I sell you like 1 crore of insurance, I'll get 6% of that. If I make you invest 1 crore in a ULIP product, I will get 6% of that as a salesman. Okay, that's very high commission. There's tremendous incentive for people to behave badly. So this is the problem. So check out the commission structure also now. New regulations would have come out on this. Okay, this is one type of investment product. And otherwise, of course, understand the basic rationale of life insurance. Again, life insurance is, again, you've done a little bit about options in your first year.
Sir.
Okay.
Yes, sir.
So understand not just life insurance, all insurance. Life insurance, also understand one more thing, the language that we used in lab. Life insurance is a species of insurance. You can have motor insurance, fire insurance, marine insurance. These are all species of insurance. Life insurance is one of those. Okay.
Yes,
So
sir.
all insurance is basically uh, option selling. Okay. So try to understand the basic, go back and revise your option structures also. All insurance companies are option sellers. Okay, so when you sell the options, insurance company is the option seller. Okay, so the insurance company, all insurance involves option selling. Insurance company is the seller. Okay, if you go back and revise your options material from first year, you'll see options is seller. Okay, so it receives a premium. Okay, remember we use this word premium for insurance also, but we use
Yes,
this
sir.
word insurance. We use the word premium even in option trading. The price of the option is referred to as the premium, which connects you directly to the insurance lingo, which is that when you buy insurance, you buy your car insurance, you have to pay a premium. And so the car insurance company is selling the option, and you are buying the option, and you're paying the premium to the seller of the option. Is this clear?
Yes, sir.
So understand this business, it's all about option selling. Okay, so how does the option, how does the option selling risk work? So if I buy life insurance, say I make my mother the beneficiary, then if I die, then my mother will go and claim. So I would have paid certain amount of premium. Then my mother will go and claim the premium and say that, okay, this person, I am the beneficiary of this policy. So that's the option being exercised. Do you remember exercise of options?
Yes, sir.
Okay.
Exercising and not
So when
exercising. Yeah.
somebody, say life insurance, when someone dies and the beneficiary comes to claim, that is the equivalent of option exercise. Okay. So basically what is happening is these guys are, the business model here is that you try to sell. Okay. So essentially, let's say life insurance, bought. Okay. Then there is death. Okay. Then beneficiary claims. Okay. Claims as in a verb. Okay. So this is equivalent to option exercise in when you go back to your so you should always connect the option lingo from finance to direct to insurance is all business of insurance is option selling by the insurance companies. So the basic business model is that collect more in option well, okay, let's put it this way: option, which is the same as insurance. Okay, option premium, collect more in option premium, insurance premium, than you have to pay out in claims. Claims is nothing but exercise. Okay, so exercise is generally never favorable to the option seller, because when you're exercising, it means that it's beneficial for you because somebody has smashed up your car. So now you are in loss. So you're claiming, now you're telling the insurance company to pay for my car repairs. So it's never good for the insurance company. They are just going to hope that they sell you the option, but you never exercise it, like nothing happens to your car. Okay. So this is basically, so is this clear? Are you following the business model?
Yes, sir.
All insurance companies, the business model is the same. Okay. All insurance is option selling. So all insurance companies, the business model is the same. That your goal is to collect more in option premium or insurance premium than you have to pay out in claims, because people are always passing away and claims are happening, so they have to pay out most of those claims. And you in exercise basically as a result of exercise of options, and then you're just hoping by the same time the sales team is selling aggressively and collecting premium, so you are hoping that you keep on collecting more premium than you have to pay out in claims, and this excess is known as basically roughly, okay, so the excess premium, okay, premium, okay, let's put it this way, premium cash flow. This is known as, generally called the float. Okay, this is how a big way or for insurance companies to make money. This is called the float. Okay, so interest on excess premium cash flow means excess of like this year I collected, let's say, 100 million in premiums, sale of insurance policy, 100 million collected in premiums. Total payouts in claims is, let's say, 40 million. So I got excess 60 million cash this year. Now going forward, this float. This is the float, excess cash. And anytime I have excess premium slushing around my accounts, that is all cash because you have to pay the premium in cash. So that comes into the account. That is all the excess cash flow is known as the float. And the interest on the float is a major source of income. Okay? Interest on float is a major source of income for insurance companies. This is one element. You see, Berkshire Hathaway, you've heard of Warren Buffett.
Yes, sir.
Okay, Berkshire Hathaway has a lot of insurance companies. You can check their website. They are big on this. This is one of their major sources of income. Okay, all the companies that Warren Buffett buys, a lot of it is from the float from his insurance companies. The excess stuff, cash that they have floating around. So this is one. Okay, so interest on float, major source of income for insurance companies. Okay, so this is one thing you have to understand. You have to understand the legal, so you have a good sense of the business model. Okay, on the legal side, I will say one more thing. Okay, when you talk about claims, okay, on claims, you will talk about claims. Okay, there is and a disclosure by well, let's say the insurance policy sponsor. Actually, the guy who buys the policy is called the sponsor. Okay, so you can just call him the buyer actually. So you can call it the buyer or the policy. Basically, disclosure is very important. Full disclosure. Okay. So we say that insurance contracts. Insurance is a contract also. Remember. Okay. So we
Yes,
said
sir.
that all insurance is a species. Life insurance is a species of insurance. We may not have written that anywhere else. Okay. And insurance is also, the insurance contract is also a contract. Okay. So now this, when you're looking at the contract of insurance, okay, contract of insurance. So this is a species of a contract. Okay. Insurance contracts are a species of contract. You can have construction contracts. You can have delivery contract, commodity delivery contract, all kinds of contracts. The contract of insurance is a very special contract. We say that this is a contract which is we use this. I'm not sure if my spelling is correct. Um, this is the term, the Latin term. Okay, uberrima fides, which means utmost good faith.
Faith.
Okay, utmost good faith. So in contract law, we have something called good faith. So if I'm, if I'm entering into contracts with you, I should enter into contracts in good faith. Like I should not have an intention to defraud. Like if I'm entering into a, somebody is entering into a contract of marriage, but I've told you that this family is entering into a contract of marriage, but they actually, the groom is very old actually, but they pass him off as a young man. They know that he's old, okay, but they pass him off and they fraudulently engage in this wedding. Now that's not acting in good faith. So in contract law, there is a requirement of good faith. But insurance is a very special type of contract. So in insurance, there's a requirement of utmost good faith. So extra requirement of good faith. Okay, that's what is called uberrima fides in contract law. Okay, so this comes from a case, a very old case which you should know about. This case is called Carter v. Bohm. Okay. You can Google it, okay, and check it out. Okay, very old case. This is the name of the case. So this is where this duty was defined. So the guy who is buying, so if I'm buying health insurance, okay, and I have some kind of medical condition, okay, which maybe nobody knows about, and I don't disclose it. Now later on, if it becomes, and later on I'm claiming my medical insurance, something happens to me, and then I'm claiming medical insurance from the company, from the insurer, and then it comes out that and the insurance company is disputing my claim, saying that this guy hid some important information. And it comes out in court later on that I actually hid some important information, which I should have revealed to the insurance company at the time of buying the insurance. Now if that happens, then that will be this thing will come into play. Okay, we have a case in India also. I'm forgetting the name. It's life insurance company versus. I'll tell you the name of the case later. But it's a case. We have a lot of cases in India also where there's a very famous case which I'm not able to recall now. Where this guy did something similar. He had a medical condition, but he hid it from the insurance company, and then he went and claimed medical insurance after he fell sick. This is not allowed. Okay, insurance contracts, courts will enforce the duty of, will look for this uberrima fides, there is utmost good faith. You have to disclose everything. So what happened in Carter v. Bogue is a very interesting case. There's a French, there's a French port in, I think the port, a fort actually. It was Fort Marlborough. There was a Fort Marlborough in Indonesia, which I think it was a British fort, and the commander of the fort bought insurance from the insurance company against the um, fall of the fort to enemy forces. So now he had not disclosed that this is Fort Marlborough actually. He had not disclosed that in Indonesia, Indonesian currency is IDR. Okay, so this Fort Marlborough against the fall of the fort. So if the fort fell to enemy forces, the insurance company would make a payout. So the condition, the option exercise condition is the fort should not fall to enemy forces. Now, what this guy, the commander of the fort, did not disclose is that the while he disclosed that the fort was immune to attacks from the natives, but he did not disclose that it was actually vulnerable to attacks from the French. So as a result of that, the French attacked and the fort actually fell. And this guy went to claim this money, the insurance from the insurance company. So that's when this doctrine was laid down. It's a very old case. That doctrine of uberuma fides, it was revealed that this guy he had the information that it was vulnerable to attacks from the French, but he did not disclose it to the insurance company. Because obviously these guys would have charged a higher premium if you did that, right? So that's basically it. So this is something you have to also understand about insurance law. All other contract considerations that we discussed, remember another very important thing in contracts, what was that point we met? Contra proferitum. Okay, let me just quiz you now. You remember what this is?
Yes, ambiguity in the terms of the contract, right?
Then what happens? That's the condition precedent for application of this doctrine. And what happens after that?
Contrary. Yeah, but the ambiguity. So I'm not able to recall.
Okay, so you're right about the condition precedent. Okay, ambiguity is the condition precedent. But then if there is ambiguity, then if there is a dispute about a clause which is ambiguous, then it will be interpreted against the draftsman. Okay, who is the draftsman in an insurance contract? It is the insurance company.
Insurance company.
Who drafted the contract is the insurance company. Remember? So I warned you guys about this when you go into HR, also employment contracts, any kind of contract. This is the general doctrine of contract law, but applies even more to insurance law. Okay. So contra proferitum, any ambiguity in the terms of contract, it will be interpreted in favor of the person insured and against the insurance company, because they are the guys. Proferitum comes from the word proffer. Okay. So remember that. Is it okay? Now you're clear about this?
Yes, sir.
Contra proferitum, you have to remember all these things. See, a lab is just ended. Now you're not able to answer. Okay. So you have to be more careful. You have to have good retention on concepts. Okay.
Yes, sir.
All right. Okay. So so don't see that as a negative thing. I mean, it's just I have to give you feedback when I see any student who is not we have to keep pushing you guys to become better and better. Okay.
Yes, sir. Yes, sir. Beautiful.
Okay. So
I'll work on it.
Yeah. So make sure all your concepts are clear. Okay. So now I think you have a pretty good idea about this. Okay. I will tell you one more thing, very important to understand. I see many people who study insurance in India and actually, let me just bring this here. Also try to know this, this was featured in the Harry Potter movies. Okay. Please read up on Lloyd's of London Insurance. They don't really deal in life as such. They're mainly a property casualty insurer. Okay. But it's a very, very big factor this is like the international hub of the insurance markets. So you must know about Lloyd's of London. Okay, try to read up as much as you can. Okay, about Lloyd's of London, so you can understand all the. So I'll put this link also in your. I will share this file with you later on. Okay, and I'll share it with the other people in your batch also. So Lloyd's of London link goes maybe somewhere here. Okay. Okay, so you must read up about Lloyd's of London. This book, you'll recognize this building from the Harry Potter movies, but very nice building, very stylish construction. Okay, but lots to learn here, how they do property casualty insurance. So many things are insured. Also learn a little bit about some of the other stuff. Okay, so the life insurance business. So generally we talk about life, we talk about life versus the taxonomy of insurance is life versus non-life. Okay, life versus non-life. Okay, under non-life you will have basically mainly. Now I'm not that much into insurance, but I can tell you basically what it's going to be. It's called property casualty. This is a term that we use. Okay, so we just call it property casualty. You will see this. Property casualty means casualty. This is the medical insurance part of it. Property is all kinds of property, fire insurance for your go downs. Okay, then under property insurance, when you're insuring goods at sea, etc. Okay, that will all come under property. But then for goods at sea, there is usually a separate category. So this is, we are talking about now categories of insurance. Okay, so broadly life versus non-life. Okay, just like you're going to classify cricketers, you classify some as batsmen, some are bowlers, some are wicket keepers. Okay, some are all-rounders. So similarly, we classify insurance. Life versus non-life is the high-level classification. Under non-life, you have property casualty, but you also have some other categories which are not really quite distinct, or they're not mutually exclusive with this, because some of that is property insurance. But we don't really call, when you are insuring goods at sea, it falls under marine insurance. Okay, marine insurance is a separate category altogether. Big, huge field of marine insurance. You will understand now. You'll know the ship Evergreen that was caught in the Suez Canal.
Yes, sir.
Yeah. So I just heard yesterday that they've seized that ship because there's nearly $1 billion worth of claims against that ship. So this business is very, this is a very big thing in marine insurance. This business of seizing the ship. So like if I have a claim against you, if I'm a bank lender, I can seize your ship anywhere in the world. Okay. So this is basically marine insurance. It also falls under basically, I'm forgetting the term, but so all this shipping of goods over sea, this becomes a category by itself. Although you could technically argue this is property as well, because it's mostly goods. But here, this property refers to basically what we call landed property. Okay, this is the fixed, what is covered under property law, not under sale of goods law. This is landed property. Whereas this is marine insurance will cover goods at sea, all kinds of other ship insurance, all this stuff. So these are all the broad categories of insurance. So in Lloyd's, you'll find a lot of property casualty. Then under this, you'll find hurricane insurance also falling broadly under casualty. Okay, so this could be either happening to individuals, which is medical insurance, and medical again is treated as a separate. So the taxonomy under insurance is not quite perfect as we would like to see. Remember, mutually exclusive and all that I taught you
Yes,
guys.
sir.
Yeah,
Yes,
it's
sir.
not so clean. It's not so clean actually. So medical will generally be treated as a separate. Casualty will be treated as accident insurance, really accident insurance kind of thing. Then you also have insurance against hurricanes and all those things. Florida, you get a lot of hurricanes in Florida. So every time there's a big hurricane in Florida, everybody is rushing to calculate the profit impact on the insurance companies, because these guys have to pay out massive claims. Okay. So now you have a big category of COVID related claims. Okay. So try to understand, although you'll be mainly in life insurance and you'll be mainly focused on life insurance investment products. Okay. But still try to use this opportunity to get an overall understanding of the insurance company. Okay. Of the insurance business. Okay. And don't lose the opportunity also to inform your seniors about how much you're studying about the insurance markets. And so use this opportunity to totally dive into the insurance markets and read about it. And then also see opportunity. Whenever you have an opportunity, please inform your seniors about how much you're reading, that you're aware of this. Say, I saw this video on the Lloyd's of London website. Maybe it's applicable to this situation, etc. Okay. So use these opportunities to show them how much you're reading. Okay. There you have these films are not very long, but you can still read about it. Okay. So understand this stuff. Now, COVID also has led to a lot of claims. Also understand this category of, you have life insurers, property casualty insurers. Then you also have people who are basically, there's another classification, which is insurers versus reinsurers. Okay. So these reinsurers, you have also this category called reinsurance. Okay, so a lot of these insurers who have insured against hurricanes and stuff like that, this is called catastrophe insurance. Okay, this is called catastrophe insurance. Okay, so these guys, a lot of these guys especially will be using reinsurance because they can't handle the liability on their own. They've sold so much insurance that if something happens, that very bad hurricane comes, these guys will be totally wiped out. So they try to buy some additional protection by selling off their risk to the reinsurers. So if I've insured, like I might insure 100 million worth of damages, okay? But what I will do is against, I can't live with 100 million. That's too much risk for me. So what I do is for about 40 million, I buy reinsurance from a reinsurance company. Okay, so if you like have here, you have Prudential, maybe Prudential has sold 100 million worth of insurance, but they're not comfortable with this much exposure because they can't afford to pay out this much. Okay, the numbers are very small. I'm just taking some arbitrary numbers. They are going to go and go to a reinsurer. Okay, like Berkshire Hathaway, Warren Buffett also owns some reinsurers, I think. Okay, there's a very famous reinsurers like people like Swiss Re. You can read up their website, Swiss Re. Swiss Re, the major reinsurer. Okay, this is Swiss Re, means Swiss Reinsurance. Okay, so these guys are very big. So you can go to their website and check the nature of the reinsurance business. So what these guys are doing is they are insuring the insurers. Okay, so understand this also. We are talking about broader facets of the insurance industry. So just because you're in life doesn't mean that you have a narrow focus only on life. Okay, but this is basically the overall view of the insurance industry. And then what we are talking about is the coming back to your investment products. Your ULIPs are mixing investment and life insurance. Okay, so try to understand the nature of this product, how it operates, what are the latest commission structures. Okay, and then you can do some. They'll give you some projects, obviously, so you can look at the stock market and see how it's doing, etc. Look at the structure of these products. So learn a little bit about these investment products. Is that okay? Right?
Yes, sir.
So I think you have a fairly good idea about the insurance industry now, based on this. Yeah. So at least you can go forward, and then of course you have more questions. You can come back, and it doesn't have to be done in one session. Okay? We can have more sessions once you have more questions. So basically, your job as a student is to keep reading and keep absorbing and remembering the concepts, and then also to generate questions. Okay, that's very important. The more you read, the more questions you'll have. Like one of your seniors was saying that the more I read, the more I realize how little I know, which is fine actually, because that's the whole objective of reading. That's nothing wrong with that.
True, sir. True. I agree to this.
Okay, good, excellent, good. So keep studying and keep working on it. Okay, keep the pressure on yourself, and keep working on it. And then we'll see if you have more questions. We can come. I'll share this with you. I'll share this with your batch also, so that everybody else going into insurance, and generally even the second years, can benefit from an understanding of the insurance industry. Okay, which maybe some of the stuff is not covered in their courses. I don't know. So we'll see. Okay, so I'll circulate this video later on with your group. Okay, so right now you have an understanding. I'll share this. I'll share this document, so you can access the document. You'll have the Lloyd's of London search also under this, and then you can query all these other products. Is that okay? All right.
Yes, sir.
Yeah. Any other questions?
No, sir.
Okay, great. So we'll end it here then. And so if you have any other doubts or anything, you can just message me, and then again we'll set up another Zoom like this. Okay. All right.
Yes, sir.
Okay.
Yes,
Take care. Good night.
Okay.
Okay.
Thank you so much, sir. Good night.
Welcome.